Hello, my name is Farah Efarina binti Adnan. Our group is presenting a financial ratio analysis of Dutch Lady Milk Industries Berhad. We chose Dutch Lady because it is a well-known company in Malaysia and is listed on Bursa Malaysia, which means its financial information is transparent and reliable. Dutch Lady was established in 1963 and is a part of Friesland Campina, an international dairy group. The company produces a daily consumed products such as milk, yogurt and milk powder. It follows strict and halal standards and has strong brand recognition among Malaysian households. Because of its stable operation and strong market presence, Dutch Lady is suitable for financial performance analysis.
Hi, my name is Hidayah. From this slide, I will explain the annual financial performance of Dutch Lady Milk Industry Berhad over 5 years period from 2020 to 2024 based on official published data from annual report. The table highlights 4 key financial indicators: revenue, gross profit, operating profit, and net profit. Starting with 2020, Dutch Lady recorded a revenue of approximately 1.1 billion. Despite global economic uncertainties, the company remained profitable, achieved a net profit about 73 million, which reflects a strong operational resilience. In 2021, the company showed a significant improvement. Revenue increased 1.13 billion, accompanied by higher gross and operating profits. Net profit rose sharply around 248 million, indicating a strong recovery and improved efficiency. Moving to 2022, revenue continued to grow to 1.14 billion. However, the profitability declined, with the net profit decreasing approximately 46 million, likely due to higher operating costs and rising raw material prices. In 2023, Dutch Lady demonstrated a steady recovery. Revenue increased substantially to 1.44 billion, supported by improved gross and operating profit. Net profit rebounded to about 72 million, reflecting better cost management. Finally, in 2024, the company delivered a strongest performance across 5 years period. Revenue reached 1.45 million with consistent growth, with gross profit, operation profit and net profit nearly 97 million.
Liquidity ratio. So this slide I will present about the liquidity ratio, present the company liquidity performance from 2020 to 2024 using net working capital, current ratio and quick ratio. So overall liquidity peaked in 2021 where net working capital reached its higher level and the current ratio improved above 1, indicating a strong ability to meet short-term obligations. However, this improvement was not sustained. From 2023 onwards, net working capital declined significantly and turned negative in 2023. With only a slight recovery in 2024, similarly, the current ratio fell below 1 in 2023 and 2024, suggesting increasing pressure on short-term liquidity. The quick ratio remained below 1 throughout the period and declined after 2021, indicating limited liquid asset available without relying on inventory. In conclusion, while 2021 showed strong liquidity performance, the overall trend from 2022 to 2024 reflects weakening short-term financial stability and highlights the need for improved working capital and cash flow management. So I will present about efficiency ratio for this. This slide present the company's efficiency performance using inventory turnover, receivable turnover and total asset turnover from 2020 to 2024. So, firstly, inventory turnover was relatively strong in 2020, but declined in the later years, particularly from 2023 to 2024. This indicates slower inventory movement and longer holding periods, which may tie up working capital and increase strong storage costs. So next, receivable turnover. Receivable turnover improved steadily from 2020 to 2022, peaking in 2022, showing that the company was efficient in collecting customer payment. It remained strong in 2023 but declined slightly in 2024, suggesting the need to monitor credit terms and collection efficiency. So, lastly, total asset turnover. Total asset turnover shows a consistent downwards trend over the 5 years period. This means the company's ability to generate sales from its assets from weakened, possibly due to asset growth outpacing revenue. So for overall, while receivable management remain relatively efficient, declining inventory and asset turnover indicate reduced operational efficiency, highlighting the need to improve inventory control and asset utilization.
Hello, my name is Shafinas, and in this section, I will explain about Dutch Lady leverage position by analyzing three key ratios. The first one is the debt ratio, the second one the debt to equity ratio, and the third one is the time interest earned. This ratio help assess how the company finance its operation, manage financial risk, and how its leverage has evolved over the past 5 years. Alright, the debt ratio shows how much of a company asset are financed by debt. A higher ratio means the company relies more on debt, which increases financial risk. Okay, so for Dutch Lady, the ratio fell from 0.67 in 2020 to 0.45 in 2021, then rose slightly to 0.53 in 2022 and stay around 0.53 to 0.54 in 2023 to 2024. Alright, so this shows that roughly half of the company assets are financed by debt, reflecting a moderate and stable leverage position. Alright, so next, the debt to equity ratio compares total liability to shareholder equity, showing how the company balanced debt with owner fund. So in 2020, Dutch Lady had a high ratio of 1.99 times, indicating heavy reliance on debt. And then this dropped sharply to 0.83 times in 2021 after significant increase in equity. For 2022 to 2024, it stabilized around 1.14 times. Alright, this trend shows the company has moved from high leverage to a more balanced and financially sustainable capital structure, reducing its dependence on debt. Finally, times interest earned, or TIE, measure the company ability to make interest payment using operating income. It is calculated by dividing EBIT by interest expense. Dutch Lady TIE peaked at 84.9 times in 2021 due to strong operating performance, although it declined to 90.6 times in 2024 because of higher finance costs. It remains very healthy. This indicates strong debt servicing capacity and low default risk. In conclusion, Dutch Lady has effectively managed its leverage through controlled debt level and strong interest coverage. This put the company in a solid financial position, supporting both stability and future growth opportunities.
Hey, my name is Sarah, and I will be presenting the profitability ratio analysis of Dutch Lady Milk Industries Berhad. For this section, I will discuss the company's profitability performance over a 5-year period from 2020 to 2024. Firstly, gross profit margins, or GPM. GPM is calculated by dividing gross profit by revenue. The graph shows a fluctuating trend with a decline in 2022 followed by gradual recovery in 2023 and 2024, indicating improved cost management. Secondly, net profit margin or NPM. NPM is calculated as net profit divided by revenue. NPM declined in 2022 but improved in the subsequent years, suggesting better control over operating and non-operating expenses. Thirdly, return on assets or ROA. ROA is calculated by divide net profit by total assets. ROA increased significantly in 2021, declined in 2022, and then recovered moderately, reflecting improving efficiency in asset utilization. Lastly, return on equity or ROE. ROE is calculated as net profit divided by total equity. ROE peaked in 2021, declined in 2022, and gradually improved, indicating better return to shareholder. In conclusion, the steady profitability ratio show short-term volatility, particularly in 2022, followed by a positive recovery trend from 2023 to 2024. Overall, the company demonstrates gradual improvement in profitability performance. Thank you.
Hi, my name is Muhammad Fadila. So for my part, I will explain about the financial ratio analysis and how the financial performance can be improved. There are several ways to improve the financial ratio. So the financial ratio can be improved by collecting payment faster, managing the inventory better, reducing the high interest debt, and controlling costs. By introducing the higher margin product can also improve the profitability. Next, how to improve the financial performance. Overall performance can be improved through the better cash flow management, cost control, efficient use of the asset, and lower reliance on debt. So for the conclusion, from 2020 to 2024, the financial performance showed the fluctuation. There was a sharp decline in 2022, followed by the gradual recovery. Liquidity and efficiency weakness, but the debt level remained manageable. Overall, the company performance is stable with the room for improvement. I think that's all for today. Thank you.